Hey everyone, and welcome to this explainer. Today, we're taking our source materials and stepping inside what is literally the master control room of India's economy, the Reserve Bank of India, or as we all know it, the RBI. Honestly, it helps to think of it not just as a bank, but as this invisible engine, the supreme guardian of the country's entire financial stability. Whether you're buying groceries, taking out a loan for a new car, or just tapping your phone to pay for a chai, the RBI is quietly orchestrating the whole system behind the scenes. Okay, let's dive into this fascinating world and decode exactly how they pull it off. So, let's start with a question we've all probably asked at some point, right? If the RBI literally controls the printing presses, why not just print unlimited money to solve poverty and unemployment overnight? Well, the answer reveals the RBI's absolute core balancing act. Simply flooding the economy with cash doesn't create real wealth, it just creates inflation. Too much money chasing the exact same amount of goods means prices absolutely skyrocket, which destroys everyone's purchasing power. This is the delicate tightrope the central bank has to walk every single day.
To understand how they manage this, we need to rewind a bit and look at where it all began. 1935. That's the year the RBI was established under the RBI Act of 1934, which was actually based on the recommendations of the Hilton-Young Commission. The whole idea was to step away from direct government control of day-to-day money printing. They wanted to professionally manage the currency, maintain long-term price stability, and set up a supreme independent monetary authority.
And let's put that into a broader global context for a second. Every major economy on Earth relies on a similar master control room. The RBI actually sits proudly alongside legendary institutions like the U.S. Federal Reserve, which was established in 1913, and the Bank of England, which goes all the way back to 1694. Together, these central banks are constantly communicating and coordinating to maintain worldwide financial order. It's like a global network of financial guardians.
Now, the sheer organizational scale required to run India's economy is staggering. Looking at the hierarchy, right at the top you've got the Central Board of Directors, which includes government-appointed officials. Then you have the governor, basically the chief executive officer. You might recognize names of past governors like the famous Raghuram Rajan or the current governor Sanjay Malhotra. Beneath the governor are 4 deputy governors, and each of them manages specific domains across more than 30 specialized departments. We're talking everything from currency management to strict banking supervision. Okay, so what exactly do all these people do all day? It really boils down to 4 main pillars. First, they issue currency under the minimum reserve system, meaning they keep gold and foreign securities as a backing. Second, they are the banker to the government, managing public debt and forex reserves. Third, they act as the banker's bank, controlling the flow of credit. But that fourth one, that is absolutely critical. Lender of last resort. When commercial banks face total collapse, like what we saw with the PMC Bank crisis in 2019 or the Yes Bank crisis in 2020, the RBI steps in to prevent widespread systemic panic and, most importantly, protect the depositor's money.
Which leads us to a frankly terrifying scenario. What actually happens if everyone tries to withdraw their money at exactly the same time? This is known as a bank run. You see, the whole banking system operates on what's called a fractional reserve system. Banks don't actually keep all your deposits just sitting in a vault in cash. They lend the vast majority of it out to businesses and individuals to stimulate the economy. If everyone demands their cash simultaneously, the bank literally collapses.
To prevent a nightmare like that, the RBI carefully monitors a bank's liabilities. And the big difference here comes down to demand versus time. Demand liabilities are highly liquid, like your everyday savings account. You can withdraw that money anytime you want. Time liabilities, on the other hand, are things like fixed deposits. They have low liquidity because they're payable only after a fixed period. And that is exactly why the bank pays you higher interest for them. You are providing stability to the bank's lending pool.
So, the crucial point is ensuring banks always have enough of a buffer. To enforce this, the RBI mandates 2 ultimate safeguards, CRR and SLR. The cash reserve ratio is the percentage of total deposits banks absolutely must park directly with the RBI in plain cash. The statutory liquidity ratio is the percentage they must hold themselves, but in highly safe assets like gold or government bonds. By tweaking these ratios up or down, the RBI directly controls how much money banks can actually lend out into the real economy.
But how do they decide when to pull these massive levers? How does the RBI balance the constant tug-of-war between fighting inflation and promoting economic growth? Think about it. If they restrict the money supply too much, growth stalls out entirely. But if they release too much money, inflation wipes out everyone's value. The answer to that lies in a very specific mandate. Enter the Monetary Policy Committee, or the MPC. Established back in 2016 to ensure total transparency,
This 6-member committee has one primary, laser-focused target: keep inflation right around 4%, with a margin of error of plus or minus 2%. That little 4% figure? It dictates almost everything the RBI does when it steers the national economy.
To hit that exact 4% target, the RBI divides its tools into two distinct categories. Quantitative credit control is basically like a broadsword. It controls the total volume and cost of credit flowing through the entire economy. Qualitative credit control, however, is more like a scalpel. It controls the specific direction and purpose of credit, allowing the RBI to target certain overheated sectors without suffocating the rest of the economy.
Let's look at the broadsword first, because this is what usually makes the evening news: the famous repo and reverse repo rates. The repo rate is what the RBI charges to lend short-term money to commercial banks. If inflation is running way too high, the RBI raises the repo rate. Loans instantly become more expensive, your home and car EMIs go up, people naturally spend less, and inflation cools down. The reverse repo rate is what the RBI pays banks to park their surplus cash. If they raise this, banks prefer to just leave their money safely with the RBI rather than lending it out to the public, which instantly drains excess liquidity right out of the market.
Now for the scalpel, the qualitative tools used to carefully direct the flow of money. If the RBI sees a crazy speculative bubble happening in, say, real estate or car sales, they might increase margin requirements, essentially forcing you to put down a 25% down payment instead of 10%. They use credit rationing to cap loans to specific sectors. They even use something called moral suasion, which is basically calling up the banks and strongly advising them to cool it on luxury housing loans. And if the banks don't listen, direct action, which means incredibly heavy financial penalties.
So we've seen how they handle traditional banking, but let's bring this right into your daily life. Have you used UPI today to pay for an auto rickshaw or a cup of coffee? Have you ever stopped to wonder who actually built and manages the rules for that seamless, instant digital magic?
You guessed it, it's the RBI. They have been at the absolute forefront of India's digital and financial inclusion revolution. They regulate the entire UPI ecosystem and digital wallets like PhonePe and Paytm, enforcing incredibly strict cybersecurity norms so your money doesn't just disappear. They've aggressively pushed the Pradhan Mantri Jan Dhan Yojana, expanding rural banking and bringing literally millions of previously unbanked citizens into the formal financial system. This has drastically reduced the cost of transactions across the entire country. But as we know, with great expansion comes great risk. What happens if all these millions of new borrowers, or even massive corporate borrowers, just decide to stop repaying their loans? How does the central bank actually shield the broader economy from totally collapsing under the weight of bad debt? This is where the RBI enforces the global rulebook, known as the Basel norms. Established internationally by the Basel Committee on Banking Supervision, these are incredibly strict standards that basically require banks to maintain a massive financial cushion. The logic is simple. If every single bank follows these strong rules, the chances of a sudden, highly contagious financial crisis are dramatically reduced. Under these norms, the RBI forces banks to build their armor in two distinct layers. Tier 1 capital is the core armor. It's the bank's own money, things like equity and retained earnings. Think of it kind of like your own personal emergency savings account. It absorbs losses immediately. Tier 2 capital is supplementary. It includes subordinated debt. It's essentially backup capital, a bit like having to borrow money to survive after your actual savings run out. The RBI closely watches these ratios to ensure banks never run dry.
And trust me, they need that armor to fight their biggest enemy, the NPA, or non-performing asset. If a borrower misses their interest or principal payments for more than 90 days, the loan officially turns into an NPA. This is the dreaded bad loan. Once a loan becomes an NPA, the bank completely stops earning income on it, and it begins to eat directly into that precious Tier 1 core capital we just talked about. Now, when an NPA occurs, the RBI empowers banks to go on the offensive to recover depositor money through a series of escalating steps. First, they can take it to the Debt Recovery Tribunal, which are basically special courts created for fast-tracking this exact issue. If that's not enough, they can deploy the Sarface Act, which is a massively powerful law allowing banks to bypass the courts entirely to seize and sell the borrower's assets. And for massive complex corporate defaults, they utilize the Insolvency and Bankruptcy Code to restructure or even liquidate the company entirely.
Ultimately, all these incredibly complex levers, from tweaking interest rates by mere fractions of a percent, to enforcing international Basel standards, to regulating the smartphone payments in your pocket, they all serve one unified purpose. As our sources so perfectly sum it up, a strong central bank leads to a stable economy, investor confidence, and sustainable growth. The RBI is the ultimate protector and the central engine of India's entire economic machinery.
But as we wrap up this explainer today, I want to leave you with a somewhat provocative thought to ponder. We've just seen how the RBI steps in as the ultimate lender of last resort to save failing banks and protect everyday depositors. But if banks know for a fact that the RBI will always act as the ultimate safety net to prevent a total panic, does that secretly encourage them to take riskier bets with your money in the first place? It's a fascinating paradox right at the heart of the modern banking ecosystem. Thanks for joining me on this deep dive, and keep questioning how the machinery around you really works.